Hi friends, today we are going to discuss about financial statement analysis. So we will also look at various financial ratios and see how we can analyze them. So in previous videos as part of accounting, we have discussed about information contained in the three basic financial statements. What are those three basic financial statements that we have looked at? One is balance sheet, second is income statement, and third is cash flow statement. So now we will discuss how this information is analyzed both by parties outside the firm and by the company's own management. Right? So financial ratios are useful for analyzing the financial health of any company. Friends, if you have not subscribed to my channel, subscribe to my channel now and then like this video if you like it, and also share this video with your friends, whoever is going to get benefited out of this, and also press bell icon if you want to watch my latest videos. So first let's check why we do this financial analysis, right? Why we do this financial analysis. So one is to check your own company health, right? Right? Your own company's health, and also to compare with other companies, right? And also another advantage of this is if you want to invest in any of the shares of the company, right? So then we need to do this financial analysis so that we know these things. So what are the financial factors, right, that we need to look into? So there are broadly categorized into 5 categories. All these financial ratios are categorized into 5 categories. So what are those 5 categories? One is profitable, profitability ratio, right? And second is liquidity ratio. And third is solvency ratios. Solvency ratios. And fourth, activity ratios. And last one, fifth one is valuation ratios. Valuation ratios. So these are the 5 different types of ratios, and let's look at all these ratios. So what they will tell us actually? They will tell us about company performance, right? They will tell us about company performance with respect to what? With respect to profit margin, right? Or short term or long term debt position, right? And is company having more liabilities or loans, right? Whether they can pay back these liabilities or loans, and how is company operational efficiency? Operational efficiency. So these are the various things that we can know by analyzing these categories, all these ratios. So let's get into all these ratios and look at how they are helpful. So first let us look at profitability ratio. Profitability ratio. Right? So what is this profitability ratio? So what it tells us? It tells us how good a company is at making money, right? So profitability is all about making money, right? So how good a company is at making money, right? And what else? Company's competitive position in the market. Company's competitive position in the market. And also this comes from income statement, and the sources are income and expenses, right? So let's look at the formula. What is the formula for profit margin? So profit margin equal to net profit divided by sales revenue, right? So net profit margin equal to net profit divided by sales revenue. So if you have higher value is the better ratio. So when you calculate the profit margin, if the profit margin is higher, then it is better. How do you decide whether it is higher or lower? It is known when you compare with your competitors or any other business which are in the same type of business, right? Also in this profitable ratios, how do you get this profitable ratio? Profits is maybe return on sales or return on investment. So there are two type of profitability ratios. One is return on sales, and second is return on investment, right? Return on sales and return on investment. So what are the ratios that we can see? What kind of return on sales that we'll get? So one is, let's see what are the types. So one is gross profit margin. Gross profit margin, right? And operating profit margin. Operating profit margin. And third is pre-tax margin. Pre-tax margin. And fourth is net profit margin. We will look at all these things in detail. So these are the different type of margins that we get on return on sales. Now let us look at what we get on return on investment, right? So return on investment. So what kind of things? It may be return on assets, return on assets, right? This is one. Or let's say operating return on assets. We can call this operating ROA, return on assets. And return on total capital, return on total capital, right? And then return on equity, return on equity. And return on common equity, ROCE. This is ROE, return on equity and return on common equity. So these are the various profitability ratios that are coming under either sales or investment. So let us now look at further details of how to arrive at these values. So we will take an example of income statement. So let's prepare one sample income statement from where we will generate these values. So let's take income statement, right? So what how income statement looks like. So let's take revenue, right, which is sales, um, let's say 200 million. Okay, we will put everything in million, so 200 is the revenue from the sales. And what is the cost of these goods sold? COGS. What is the cost of these goods sold? Let's say this is 80 million, right? So now from this you will know gross profit, right? Gross profit. So what is the gross profit now? 120 million, because you will do minus expenses, cost of goods sold. So you will get gross profit. So now after that, what you will do to get the uh, other profit? What is that? EBITDA. So you need to reduce other expenses, right? Let's say you have some marketing expenses, marketing and sales expenses, or let's say office expenses, right? So let's say marketing expenses of 20 million and then office and admin expenses of 10 million. So now what you get? EBITDA. What is EBITDA? So here 120 minus 30 is 90 million. So EBITDA is 90 million. What is EBITDA? Earning before interest, tax, depreciation, amortization, right? So now what we do? We will go ahead and deduct other two things, that is depreciation and amortization, right? So let's say depreciation we will reduce around 10 million, and amortization for time being, let's say 0, there is no amortization. So now what you get here is EBIT. What is EBIT? Earnings before interest and tax, right? So how much it is coming to? 80 million, right? So after this we need to reduce the left out is what? Interest. So let's reduce interest. So if you, let's take 20 million as interest, right? So then profit before tax. So how much is the profit before tax? This is 60 million. And then what is left out? Tax. So let's say tax is around 30% if I consider. How much? 18. So finally net profit is 42 million. This is net profit, right? So this is the net profit of the based on this income statement. So now let us look at these formulas, whatever we discussed, right? So what is the gross profit margin, what is operating profit margin, and what is pre-tax margin, and then net profit margin. So let us look at one by one. So first one we will take gross profit margin, right? Gross profit margin. So what is gross profit margin? How you will get? You need to take gross profit divided by net sales, right? So what is the gross profit here? Gross profit is 120, right? This is the gross profit. So 120 divided by what is the net sales? Sales is 200. 200. So equal to 0.6, which is 60%. So gross profit margin is 60%. Now let's look at operating profit margin. So how do you get operating profit margin? Operating profit divided by net sales, right? So what is the operating profit here, which is 80, right? Let's put it in a different color. Operating profit is 80, right? And then net sales is 200, right? So now what is the value coming here? Operating profit 80 divided by 200 equal to 0.4, which is 40%. So this is operating profit margin. And next, let us look at pre-tax margin. Pre-tax margin. So how do you get the pre-tax margin? So this you need to take profit before tax divided by net sales, right? So what is the profit before tax? Profit before tax is 60, right? Divided by net sales is same 200. So equal to 0.3, which is 30%. Okay, now last one is net profit margin. Net profit margin equal to, how do you get this? Net profit divided by net sales. All are divided by net sales only. So what is the net profit here? Net profit is 42, right? So 42 divided by 200 equal to around 0.21. So it is 21%. So this is how we calculate these margins. So, if you look at these values analysis, right? So gross profit margin, if you get higher margin is the better, right? So when you get higher gross profit, it is always better. So how do you get higher profit margins? Either by having higher pricing, competitive advantage, but you need to have superior product, superior branding, and exclusive technology, right? Then you will have, you can have higher pricing, and then you will have competitive advantage, and then you will get more profit in gross profit margin. Or another option is you have to lower the cost, right? So if you lower the cost, then also you will have more gross margin. If you have operational efficiencies are improved, right, economies of scale will factor lower cost, and then you will get higher margin. So next, if you look at operating profit margin, right? So if operating margin growth is greater than gross profit margin growth, right, then you will have greater control over operating costs. So that means on this marketing or office expenses, you will have greater control. Otherwise, if it is less, then you will have deteriorating control over operating costs. So if you look at pre-tax margin is operating profit, right, minus interest. So how do you get profit margin? Pre-tax margin, profit before tax. Profit before tax is operating profit minus interest. So pre-tax margin reflects effect of interest on margins. And the last one is pre-tax margin, right? So then now once you have all these four parameters, so how do you know how your company is performing? Only when you compare with other companies. So how do you compare with other companies? So comparing companies. So only when you compare, you will know who is performing well. So let's say uh, company 1 is in telecom business and company 2 is in technology and company 3 is in automobile, right? Let's say if you are comparing companies, then you should compare one telecom company with another telecom company. But if you compare the telecom company with technology company, then you will not get any proper results. So this is wrong and this is right. So you need to compare only with telecom versus telecom. Or if you are comparing automobile, you compare only with automobile. But if you compare with technology, then that is wrong way of comparison. So basically you need to compare companies in the same sector, right? So you need to compare companies in the same sector to get the better analysis, correct financial analysis. So now let us look at second category, that is liquidity ratios. Liquidity ratios. Okay, so how comfortable a company is to pay its debts in short term. So liquidity ratios are for short term debts, right? So what is the formula for this? Formula is current ratio equal to current assets divided by current liabilities, right? So the ratio is current assets versus current liabilities. Current assets should be higher and current liabilities should be lower. So then you will have higher value. Higher value is lesser risk, right? So this is the better for the company. So this is all about liquidity ratios. Then now let us look at the third one, right? That is solvency ratios. Solvency ratios. So what is solvency ratios? These are related to long term debts. Long term debts, right? So previous one what we looked at is short term and this is long term, right? So again here what is the formula for this debt ratio? Debt ratio equal to total liabilities by total assets, right? Total liabilities by total assets. So how much debt is used to finance its assets? If it is lower, is better. If it is higher, it is risky, right? So it should be always lower. So if you let's look at the comparison between liquidity and solvency. Liquidity versus solvency. right? So this is overall financial position. Okay, so let us take some examples. So you have some assets and then you have some liabilities, correct? So here liquidity solvency talks about, one is short term asset, short term, and then another is solvency is long term. So let us take both the categories and then check. Let's say you have a cash of 100 million, and you have property of let's say 40 million, 400 million, right? And you have some machinery of let's say 50 million, right? And then you have some furniture of 40 million. So total how much? 590, right? 590. So you have total assets worth of 590 million. So now let us see liabilities. You have let's say home loan of let's say 300 million, and you have car loan of let's say 10 million, very big car, huh? Then let's say you have some personal loan of 20 million, right? So what is the total? 330. So now if you look at assets and liabilities of this company, assets are higher than liabilities. That means the solvency is good and you are in a good position. But if the assets are less than liabilities, then it is a negative value, right? So let's say here the net asset value is how much? Net worth or equity. Equity is how much here? 590 minus 330, which is positive value, right? 270. No, 260, right? Right. So it is in positive value. So it is in better position. But if it is coming in negative value, then insolvency, and it is in dangerous position, right? So similarly, when you take liquidity, which are short term assets, let's take cash you have, which is short term, but other things let's consider as long term, and then here you consider these two as long term, and then this is short term. So then what happens now? You have cash of 100 asset minus personal loan, which is 20. So you are in better position, right? Positive value. But if it is in reverse, then you will be in trouble. So this is the overall financial position with respect to liquidity versus solvency. So now let us look at the fourth category, that is activity ratios. Activity ratios, right? So this measures operational efficiency of a company, right? Operational efficiency of a company. How well a company manages its working capital and long term assets to produce more value. So, what are the things? How well a company manages its working capital. and long term assets, right? So how a company is managing working capital that is available and as well as long term assets to produce more value. Also, this is also known as efficiency ratios or asset utilization ratios. So now let us look at the formula inventory turnover ratio equal to cost of goods sold divided by average inventory. So let's say you have 100 million cost of goods sold and average inventory that you have is 100, so then it is 10. So if you have higher, then it is better and it will help in fast turnaround. So this is all about activity ratio. So now let us look at the last one, that is valuation ratios. Valuation ratios, right? So this is used for what? This is used for investment decisions, right? Investment decisions. And what is the right value of the company? You will know from this valuation ratio. What is the right value of company? This is very important, right? Because we keep investing money, so we need to look at these ratios before investing in any company. So here, what are the various formulas? One is earnings per share, right? So how do you get this earnings per share? Net profit divided by number of outstanding shares. So this is how you get the earnings per share. And what is the PE ratio? Price per share divided by earnings per share, right? So lower the PE is fairly priced and better for investment. If it is lower PE, then it is good for investment, right? So this is all about valuation ratio. So you have different type of other formulas that I have just captured here. Maybe you can utilize for exam purposes. What are the various formulas related to overall performance measures, right? You have price earnings ratio, return on assets, return on investment capital, and return on shareholders equity. And profitability measures, you have gross margin percentage, profit margin, earnings per share. And you also have how you measure this, number of times or in percentage, right, or in currency. And then you have investment utilization formulas: asset turnover, invested capital turnover, equity turnover, capital intensity, and days cash, days receivables, days inventory, inventory turnover, working capital turnover, current ratio. And then finally you have financial condition. So financial leverage ratio, debt ratio or equity ratio, debt or capitalization, times interested earned, right? Cash flow debt, and finally dividend policy. What is the dividend yield? These are the important formulas that are useful for exam purposes, right? So friends, this is all about financial statement analysis. Hope you understood and enjoyed this session. So please subscribe to my channel and then like this video and share with your friends, whoever is interested in watching these kind of things and who are going to get benefited out of it. And also press bell icon if you want to watch my latest videos. Thank you. See you next time.